Therefore, and Northern Ireland is, in my opinion, what will change everything. So it is good. It is good that there is a dialogue, even if it looks a little bit messy from the political perspective, because it makes the EU understand better the reality of the Northern Ireland situation as regards the UK and as regards the rest of the European Union. And it also makes the UK stronger in terms of providing messages that have not probably been presented to Brussels properly in the past.
Can Theresa May survive this? Because look, she stood there stubbornly and said, my deal is the only deal.
Yeah.
We've had 3 votes on it. Each time it's been rejected. I didn't hear anything from her last night that suggested more flexibility on that deal, or from the Europeans, to be honest. I mean, all they've said is they've restated that the negotiated agreement is the agreement. So if it's represented a 4th time, is there any reason to believe it'll be more successful?
It has to change. That everybody, I think, that by now understands. Obviously, the European Union is playing tough, and that's their role. They're doing what they have to do. But from the UK perspective, the Prime Minister cannot just continue to present the same deal that is being rejected over and over again and believe that next time will be different. What needs to happen is that the deal that is presented to the EU, precisely because now that there's a prolonged deadline, the deal that is presented is something that is acceptable by Parliament. And this concept that this is the deal and nothing else can be changed. To be fairly honest, we all know that politics doesn't work like that, and that what you need to do is to reach an agreement that is acceptable for both the Conservative and the Labour MPs that have voted against it.
So we just need the people to vote now in the European elections, which is sort of a vote for the Halloween Brexit, isn't it? So we don't crash out on the 1st of June.
Well, I mean, you raised so many more interesting questions about where the European elections are going anyway. I mean, we're going to talk about Spain at some point, but now potentially with the socialists in a position to win in Spain, you've got that issue of fiscal responsibility rearing its head again in that economy, and the Italians, as we know, have taken again the EU. So what happens as a result of their resistance to overtures from the Commission? I mean, it just runs and runs, this.
Exactly. So many more questions, so many more answers.
Daniel Lacalle is with us, Chief Economist at Tressis Gestion. Any reason to believe that the Eurozone data will improve later on in the year? We had one of our earlier guests make that suggestion. Hard to know what the catalyst would be for that.
It's very unlikely. We've seen a moderate bounce in March. Tends to happen. That bounce that we might see in the March data, maybe in April, is not likely to become a trend. And the reason why is because since QE started, most of the Eurozone countries have completely abandoned the reform agenda. The second is that most of the investment that goes into the Eurozone has been basically recycling of capital, and as such, you have very little capex growth. Obviously, you have the demographic factor, and you also have the high debt and high government intervention factor. So all those combined make it very, very difficult for the Eurozone to grow. The driving force for the Eurozone growth has been the external sector, the contribution of exports to the economy. That has probably reached a peak with the global slowdown, with the challenges to basically get it further than where it went. And what the Eurozone has failed to do is to implement supply-side reforms that would improve the economy inside and to allow businesses to thrive.
So the money question on rates then, because our last guest was saying, well, if you do see some improvement in the data, then you could have hiking early next year. When do you think rates are most likely to move from the negative deposit rate scenario that we've got currently?
It looks very unlikely that the ECB will hike rates anytime soon. You have on one side a very high proportion still of non-performing loans in the Eurozone banking system. You still have a very large percentage of zombie companies that are unable to pay their interest expenses with operating profits in the European quoted market. And additionally, very difficult when you have so many countries that are unwilling to reduce deficits. You have now, for example, you have in Spain, the Spanish government is spending a lot more, wants to spend more, wants to increase the imbalances. In Italy, we have already seen it. So there's this misguided view that now is the time to increase deficits for many of the countries.
If that is the case, and there's fiscal expansion, then surely that does mean there is actually room to tighten on the other side on monetary policy. So would you put any 2020 date into the diary on a rate hike? The ECB?
I would not. I agree with you that the ECB should look at the data and say, look, it is the time for at least one rate hike to show that ultra easy monetary policy is not going to be here forever, and also to give guidance to governments and to in general the Eurozone that this cannot go any further, that countries cannot go back to 2008 mode and say we're going to massively spend our way out of a slowdown, because what it means is that when you ignore the slowdown and you introduce even further imbalances, you enter into 2011 type of crisis. And that is something that the ECB should be thinking. It should be both thinking about, yes, supporting the economy is fine, but there is also an element of saying, hey, governments, you really need to get your act together, because something is going really badly when you have countries such as Spain, in which the government is every weekend, every Friday, increasing massively government spending in order to try to win elections. Huh?
And Dan, thank you very much.
Well, Dan Lacalle is with us, Chief Economist at Tressis Gestion. And as we look at the weakness on the overnight markets in Asia, Dan, there is, I think, an interesting line you have compared with the consensus at the moment, that you don't think emerging is a safe place to park money at the moment. Mm-hmm. Most investor surveys are coming back with a more positive attitude towards emerging markets. You don't agree?
The reason why I don't agree is because you have the first signals again of weakness in emerging currencies. The Argentine peso, the Turkish lira, the Indian rupee are already showing a level of weakness that is quite a concern, particularly when the Fed policy is of easing, when the Fed policy is of maintaining low rates, and at the same time when the dollar is not moving, the DXY index. So that's the first signal to be concerned about. The second is commodities. Commodities have risen with liquidity and with global money supply growth. That is fine. However, the macro data, supply and demand fundamentals are showing the same level of weakness that we were thinking about at the end of last year, if anything, a little bit worse. Therefore, you need to be aware at least of the fact that both on the currency side and on the commodity side, probably the tailwind is behind you. And the third one is the level of extreme complacency with debt. That is fine right now, but money supply growth has virtually stopped growing since February. So if you see money supply growth at a global level stop growing since February, you at least have in the next 3 to 4 months some warning signs ahead of you in terms of the real GDP growth that is going to come up. So I think you need to be a little bit cautious, simply because most of what you could as a fundamental investor expect out of emerging markets for 2019 has already happened. That's it. That is simply it, is that you have it, you bank it, and you move on to safer territory, in my opinion.
If you are chasing growth, then it's not going to come from these so-called fast-growing markets in Asia or parts of Europe or Latin America. Where would you turn focus? Is it, that usual suspect, technology?
Technology is it, but it is it, because you cannot expect that what everybody is seeing, which is disinflationary pressures, you see in some slowdown in the major economies, and at the same time the overcapacity being perpetuated by very low rates and very high debt. You cannot expect the traditional drivers of growth to help you in your investment case. So commodities, headline inflation, etc. Where are you going to see the growth? The growth is in disruptive technologies. That is where you have real, sustainable, and actually fundamental growth.
Even from current levels, though, Dan? Because if you look at the NASDAQ, it's close to a 6-month high. So isn't some of this already priced in where investors have gone stampeding into growth stocks like tech?
Yeah, but let's talk the concept of being priced in, because yes, obviously the NASDAQ is expensive. Obviously technology is expensive. Relative to what? Relative to a zero interest rate environment? Relative to $11 trillion of negative yielding bonds? Relative to 17 countries with the yield curve inverted? Therefore, in reality, it is not that expensive. And again, compared to value traps. So what we need to be aware is that, yes, those multiples are maybe high, but they're high for a reason. And we need to be, as always, extremely aware of multiples that are low, but low for a reason as well.
Dan, thank you very much for honing our focus on growth at this point. Let's push on.
Or is it?
Well, it is. I think that nothing compared with Greece. I think that we are not in a credit crisis and definitely not in a contagion credit crisis.
But we are in contagion crisis in the sense that if there were to be a hard Brexit, if Europe decided not to agree to an extension, that would be effectively for some countries potentially crisis because of the economic ramifications.
But again, I completely disagree with the rhetoric that hard Brexit would entail a massive crisis, because what we're hearing all the time is the message from politicians, and politicians will always say that it is impossible to reach a deal. And there are many ways of reaching a deal. Even at the WTO, you don't need to reach a deal in order to continue to have trade agreements between the countries. But again,
but that's the case, then why vote for an extension if it wasn't such a pressing issue for all of the European countries? Rip off the Band-Aid and just trigger a hard Brexit. And I think it was a crisis for the likes of France, for instance, where it couldn't effectively afford to have another sort of impact on the economy, because that would write off Macron's fortunes possibly for the rest of his presidency.
No, but I understand from the perspective of the UK and the EU that it is better to have a framework, a deal by which to smooth out the process and go further. I completely understand that. But I am completely against the idea that it is going to be a nightmare if it doesn't happen. And the reason why it is not going to be a nightmare is because, unlike with Greece, what you have is all of the different mechanisms, that the monetary mechanism, the trade mechanisms, WTO, the Bank of England, the ECB, in every single sense, monetary, fiscal, and trade mechanisms are not the same as with such a weak economy as the Greek one was and probably continues to be now. So what I would say is, great to have a deal, great to have a good deal for both sides. Fantastic strategy from the EU to play hard and all that, because obviously they need to keep the club together. That's great. And also probably a good strategy from the UK to let the European elections pass and start talking with a different European Union, because maybe the results of the European elections will be a wake-up call for the view of the centralized planning type of EU that we've been accustomed to. Therefore, I think that we're hearing too much about the risks, but too little of the opportunities.
I was going to say that is optimistic that there could
be a
changing
I'm
group
optimistic in general.
Brussels.
The big story, of course, we talked about yesterday was our very own interview with the Verdi Trade Union, which appears to be taking quite a tough line now on the prospect of job cuts from either of these organisations. It does raise questions about what the economic value of a merger would be without significant cost reductions.
Yes. No, absolutely. And I think that if you look at mergers and acquisitions in the past 10 years, if you don't achieve decent cost reductions and if you don't make the new company stronger from the beginning, what ends up happening is that there's an ongoing process of value destruction in the following years. No? So I think that it is important to have global leaders, and it's important to have companies that can compete on a global basis. But you need to have some level of improvement in efficiency. And if you don't achieve that very early from the beginning of the merger, then it just drags on, because obviously mergers also have costs of the merger process itself. So companies, the process of becoming stronger is important, but the process of becoming stronger has to start with very decisive actions in terms of improving efficiency and improving the cost base.
The constant criticism about European banks is that there's just too many banks, not enough consolidation. But here's the first major attempt to put two big banks together and start that process. Yet the criticism has been extraordinary. The pressure from labour unions has been very strong. What hope is there for the rest of the European banks if this is the signal that we get for an attempt to consolidate two German lenders?
It's a misconception in general that what the European banks need is consolidation in itself. We need inter-country consolidation. So we need countries to have some of their banks joining other banks in the Eurozone. One of the problems of the Eurozone is that you have this sort of national champions in which you merge banks from one country with another country, and therefore the process of risk-taking, the process of analyzing risk itself is at the same. It remains pretty much the same, even if they're global leaders. So what they need to do is not just think about mergers. They need to think about a less bank-driven economy. The Eurozone is the most bank-exposed real economy in the world.
On that, but the first example of this, if, say, Commerzbank were to tie up with UniCredit, one of the mooted deals, the problem is, where does it leave Deutsche Bank? And many people think that would put it in a very, very dark place. So in practicality, it doesn't seem possible to be able to consolidate cross-borders in this situation.
Yes, but cross-border mergers are important in order to cement the Eurozone itself. The second thing that I think is important is that... So
even if that casualty would be Deutsche Bank to improve the fortunes of the Eurozone, then Deutsche Bank should be let go.
I'm not going to make an assessment of where Deutsche Bank is going to go, but definitely what I think is that you don't create a stronger bank by joining two entities that have similar weaknesses. And we have seen it already in Spain with the merger of the savings banks, which worked horribly. And remember how much it cost the taxpayer, for example. And the same with Italy. So it's not just about merging. It's not just if the challenges of these banks go well beyond or whether they need to increase in size or whether they need to be bigger in terms of global reach. Those challenges are more due to the nature of the business and due to the nature of the business particularly in the years into the 2011 crisis. Therefore, what I think that needs to happen is, if there's logic in the merger, go ahead with it. But let's show that logic first, because it's not very clear to me. When you look at the messages from the FOMC, one of the things that you get very clearly is, yes, the economy is robust, the job market is strong, and inflation is sort of in line with the overall target. However, they also talk of not raising rates, and more importantly, some of the members are already talking about QE instead of quantitative tightening. So one of the things that I find always quite a challenge when I read the FOMC meeting notes is that there's this difference between the message of the overall economy while they're saying that they're going to completely U-turn on the idea of quantitative tightening. What makes you think that they will be reversing that message?
Yeah, I think they're super cautious about how they proceed from here in terms of rate tightening. We've had a fair bit of tightening already, and it's clear they feel we're getting close to neutral. Now, if data picks up, they've made from their past track record of December and January, that when they flipped right back from tightening to not quite easing, but a pause. We can see that flipping back again. I think there's still room for them to raise it a couple more times maybe this cycle, because they do want to get a little bit more ammunition in the locker for if and when there is a recession.
So when you look at the FOMC meeting notes and you read, one, that the economy is strong, two, that they're not going to hike rates, most of the market, what they're looking at and what the message that they're getting is actually the economy is not that strong. So what you believe is that actually the macro data is strong and that the change of tone will likely come from monetary policy, not from worsening of expectations.
I think that's a fair way of putting it. We view the market's reaction as looking a little bit backwards into effectively Q1 and maybe Q2 of this year, rather than looking forwards to the second half of the year, and that's where we're trying to position ourselves at the moment.
How do you translate that into an investment decision? Then what are you doing around interest rate sensitive stocks or sectors?
Well, so far we've had quite a good deal of success in some surprising sectors, actually. I mean, the utility sector over the last 12 months, 15 months has been actually very, very strong, and you probably wouldn't have picked that a year ago. So we've had some success there, but we don't want to push further down that road because of what I've said about the rates outlook. We feel some of the best areas are in growth quality stocks, where they can continue to churn out numbers in pretty much any economic environment, and that gives you some downside protection if you do get that cyclical peak in the cycle, and you have a sell-off in the more industrial and cyclical areas.
Can I just pose the question around data, whether we're getting better data? Because yesterday was interesting, the States around the CPI numbers. There's a problem around apparel, and effectively the BLS has now changed the way it's been gathering data with a big data source directly apparently from an unidentified department store's transaction records that shows seasonal weakening in the numbers. This is compliments of our high-frequency trading. They've pointed out that the change in the data gathering. That's good news, isn't it? Because we're getting a genuine read on what's taking place on the ground, rather than sort of old economic gathering of statistics that gives us what we think are data points that we think we should be changing monetary policy on. So we're going to get better numbers to work with, right?
Absolutely.
I think that's absolutely right. And look, the track record of economic revisions after the event is rather disappointing if you think about it, because you form your decisions based on effectively erroneous data. If we can get
sort of passed you by the time you get the revisions.
Well, exactly.
Right?
I mean, every now and again we get a realignment of the basket, and one item leaves and another one comes in. But if we can get real-time or more real-time data, then that's going to make decision-making better.
Is the Japanese market Bank of Japan bet? Because Japan, yes, it is comparatively cheaper, but it's always comparatively cheaper because of the structure of the corporates that are in the Nikkei. Basically, you have conglomerates with very low growth, with loss-making businesses added to high-growth businesses and things like that, and very attached to the government. So when you look at Japan, the Nikkei itself, are there any sectors that you would avoid at all costs because of those historical value trap factors?
Yeah, look, I mean, the return on equity in the Japanese market is pretty low, very low by international standards. But that's one of the opportunities that we see as companies begin to focus more on getting shareholder returns up. So we think that's an opportunity. We would not necessarily go for the big autos, the big banks. I think it really is a stock picker's market. We want to play through the kind of funds that we invest in. We want to play the themes of companies which are improving their corporate performance. And if we were to have a tracker in Japan, we'd go for one focused on the corporate reform index, the 400 rather than the standard Nikkei. So we think that is a trend and a theme that we can play for multi-years, but very specific, as I say, not the kind of behemoths which still don't make that much money and have really, really low returns on equity. We want to see Japanese companies moving their return on equity much closer to Western standards and certainly above 10%.
To talk about Spain, the Socialist Party is expected to win a little more than 30% of the seats in Congress in the country's general election later this month, according to a poll from the CIS Public Research Institute. The Conservative Popular Party is seen gaining the second largest amount of seats, followed by the Citizens Party. Snap elections were called in Spain earlier this month after Prime Minister Pedro Sanchez failed to gain enough support in Congress for his 2019 budget plan. And we should just declare Daniel Lacalle, who is with us as our guest host this morning, as the economic spokesperson for the Popular Party and a PP candidate for Madrid. So good luck.
Thank you
Daniel.
so much. Thank you very much.
Look, the country has had a little bit of a honeymoon period since the financial crisis, and the markets have given Spain the benefit of the doubt, I think, and they've said this is an administration that's kind of quietly got on with the business of trying to deal with the economic legacy of the financial crisis. But you don't think enough has been done to really dig Spain out of its current problems?
There is a reason why we talk about a recovery in Spain, and that's because there were very important reforms made by the Conservative Party, by the Partido Popular. Those reforms have been instrumental to allowing the country to go from an absolute devastation. There were more than 3,000 jobs being lost a day at the peak of the crisis. So to get the country back on track. Now that needs to be, one, cemented, second, improved. And the risk that the country is falling into is to think that all reforms have been done and that nothing has to be done anymore. Even worse, that reforms have to be reverted and that we need to go back to the 2008 policies. So that is a big risk, because obviously the fiscal space of the country is very limited, and obviously the monetary space is also exhausted. We've had massive QE and we have very low interest rates. So what the country needs right now is supply side reforms, is to let job creators, let families breathe, get a little bit more disposable income, grow and improve the country's economic situation.
But often the Jekyll and Hyde aspect of that is that you also have to rein back fiscal spending.
Yes.
Right? So,
yes.
And that is politically unpopular at a time when many feel in Spain that they've already experienced enough austerity and household budgets just haven't grown.
Absolutely. I think that the key thing is to explain to citizens that it's not a question of austerity, it's a question of spending better. And that is something that the European Commission, that the IMF, everybody acknowledges. It's not a question of cutting on services, it's cutting on political spending, it's reducing inefficiencies, it's also improving the GDP component. In the reforms that the Conservative Party, that the Partido Popular is proposing, what we're looking is to boost GDP, which is the key factor here. It's not just is reducing the administrative burdens, reducing bureaucracy, improving disposable income, things that the country with enormous potential needs in order to not just think about 2.5% growth as the maximum that it can achieve, but the reality of 3.5%.
Daniel, I just want to ask a little bit more about your budding political career here, because even though your fortunes might be good, the PP is not predicted to win the Spanish election, and so far the Socialist Party has been polling fairly well. Does that mean if you won your electorate, if you won Madrid, you would be happy to sit in opposition? Yeah,
well, the first thing that we need to see is that if you look at the landscape of Parliament, as the way that it's shown in the polls, and the poll that you just shown over there has been highly questioned by everybody because of the, let's say, tweaking from in favor of the Socialist Party, but doesn't matter. anyone is going to be looking at some form of coalition. The key thing here is whether the coalition that is going to be in power after the elections is going to be a coalition that supports supply-side reforms, that supports disposable income and this supports growth, or whether it's going back to the policies of 2008. And that is the debate right now. I think that what the country's voters, by the way, almost 38% continue to be undecided. So it's a very, very, let's say, tight race into the elections. But what the country needs to do right now is to talk really about the key aspects of how do we make a recovery turn into solid growth and solid job creation. That's only with supply-side reforms.
I think you just spelled out your case for being the next finance minister there in Spain.
But I mean, Spain is on the list of countries that the IMF has yet again downgraded in this latest round of IMF forecasts. So 2.1 is, I think, what they're now talking about for the Spanish economy here. The challenge, it seems to me, is not just how the Spanish economy performs, but those major economies that Spain actually exports into at this stage. And as you look around the Eurozone, there isn't a great reason to feel more confident about those opportunities opening up for Spanish exporters.
Let's start from that very important premise, is that the government is ignoring the slowdown. And it's ignoring the slowdown and talking about implementing the policies that take us back to 2008. So that is a big risk. Ignoring the slowdown was a big driver of Spain getting not only in line with the rest of the Eurozone countries in the crisis, but getting into a worse crisis than the average of the Eurozone. The second is the slowdown is an opportunity for Spain to address that opportunity of improving precisely exports, precisely attracting capital. Those things are very easy to do, because Spain has been able to go from a country that exported reasonably to exporting almost 30% of its GDP in an environment in which most of its trading partners were either in decline or in slowdown or in pure stagnation, like what happened with Brazil or what happened with France. So what we need to do is to continue to be competitive, is to continue to be improving that, because there's plenty of opportunities globally. There are 73 trillion out there willing to invest in a country that has so much potential as Spain. Second, there is plenty of countries to export to. You don't need to focus only on the Eurozone countries, and there are plenty of countries, as we explained earlier, that have enormous levels of growth. So what I think is that in many cases, when we look at the economy, I see other parties looking at the economy inward. They look at the economy, at the Spanish economy, as if it was the only thing in the world. And I look at the world and I see monstrous levels of opportunity, fantastic levels of opportunity, that in which a country like Spain, only by attracting 1.5% of those opportunities that are out there, will address the slowdown, will grow more, and will actually increase employment further.
The point you made earlier on in the program, though, I think is very relevant here, and you talked about some of the challenges around this Brexit extension because of the May European elections, and how this wave of populism could throw up a fairly disruptive new parliament. Same applies for Spain.
Absolutely it does. Absolutely it does. And what we need to go back is to sanity. We need to remind citizens that what happened between 2008 and 2011 was not something that has forgotten and that it will never happen. We need to remind people that we need to go back to the solid policies that have made the country progress, and that we cannot take the recovery for granted.
Dan, nice to see you this morning. Thanks for joining us, and best of luck with your bid to become a politician. Dan Lacalle with us from Tressis Gestion. That's Squawk Box. Thank you for tuning in.